welcome back, ACCA students. My name is Neeraj Sen. I'm your ACCA trainer. Let's understand the cost of capital chapter. Here we will understand the first we understand the what is mean by capital. So a capital is a so a capital is a is a resource that is used in business to generate income. Okay, so a capital is a resource that is used in business to generate income. Okay, so a capital can be in money form or in asset. Actually both are asset, but let's bifurcate it into into money, that is cash, I can say. Okay, and the other assets that can be the us, like the machinery, land and building that we put in the business. Okay, and also the money that we put in the business. Okay, so for this chapter we only take the money, that is we will only consider the money capital. Okay, so for this we need to, because we don't have the money to require that to run the business. Okay, so we will borrow this money from where we borrow this money. We will borrow from or we take money of equity, debt and preference share. Okay, or bank loan. So we are taking money from equity holders, debt holders, and preference shareholders. So when we take money from these, so they expect something in return, right? They expect something in return. What they are expecting? They are expecting some income from us. So that income for them, that we provide, they provide the finance, we provide the return, that is in the form of, income for them. Okay, that income is the cost for us, that income is cost for the company, right? That income is cost for the company, and that cost is the cost of capital. That cost is the cost of capital that we borrowed from them. Because we borrowed from them, that's why we are providing the return, right? That's why we are providing the return. So that return we are providing to the finance providers, that is called the cost. So if I ask you then what is the cost of doing ACCA, you will say that the exam fees that I am paying to the ACCA, that is my cost. Okay, so that is my cost, the exam fees. So likewise in the business sense, the what is the cost that we are paying to the providers of finance? So that cost is the return that we are providing, that is the return. Okay, repayment of capital and risk. Okay. So in return they get dividend, right? Dividend. In return they get interest. In return they get dividend. Okay, so this dividend is optional. This interest is mandatory. Mandatory, I can say. Okay, this dividend is optional. But preference over equity dividend. which means that if dividend is distributed, then this dividend will be distributed to preference shareholders first. Okay. So then next is the repayment of capital. No repayment of capital. Yes. No. Okay. Here the risk. So because they are not getting the repayment, and the dividend is optional, so they, which means they are taking higher risk, which means equity holders are taking higher risk. Also they are the owners and participate in the business activities, so which means that they are the owners and taking higher risk. Okay. So next is the debt. So that for debt the risk is low low risk. Why low risk? Because they are getting the interest that the company has to pay in any case. Okay. Also the repayment is also done to debt holders when the tenure and when the finance period and when the tenure of the debt which the company taken the end, then the company repay the capital to the debt holders, so they have the lower risk. Okay. So they have the high risk as well, high risk but lower than equity, because they are have the preference that if dividend is distributed, then it is distributed to preference shareholders first. Okay. So if I say that the equity, the return that we are providing is the dividend, so can I say that we can calculate the cost of capital by using the dividend, that is dividend valuation model. Okay. So if we can calculate the cost of capital using dividend, that is dividend valuation model, here we have the dividend, so we also calculate the cost by using the dividend valuation method. Okay. So here we also have the another method that is very different. I will tell you after some time. Okay. So the debt can be irredeemable, convertible, and non-traded. Which means that redeemable means repayment of capital. Okay? And irredeemable means no repayment of capital at the end. Okay. So if you borrowed $10,000, you repay this capital along with the interest. But here we don't repay the capital. Okay. We don't repay the capital, only the interest we will pay. Okay. So it can be the redeemable and irredeemable. So based on this, we have to calculate the cost of capital. That is that we have the different methods for both of them. Next is the convertible. Convertibles have the issued as debt, but you can convert into equity. Okay, which means it is convertible. Okay. So for this we have the different method we need to learn. So also we take finance from the bank, that is bank loan. So bank loan is non-traded. Is not tradable on the stock market, not tradable on stock market. But these debt, that is redeemable, irredeemable, convertible, all these are tradable. These are also tradable. Okay. These are also tradable. I mean this one. Okay. This one is also tradable on the stock market. You can buy and sell through the stock exchange, but bank loan cannot be traded on the stock market. Okay, so this method CAPM, it's very logical, but let's understand this. The return that the equity shareholders are expecting, because they are taking the risk, which means that they are something risk risk free, that must be minimum return, which means they are expecting something that is risk free plus something that is premium, which means premium is that they are taking the risk. Premium is for the risk taken, but for something that is risk free, they have to get the minimum return. Which means they are expecting something that is minimum, but in addition they are taking the risk. That's why they are also expecting the something bigger. It means more, which is the premium. Okay, the whole background of this chapter. Now we have to understand the numerical part of all these. Okay, for the equity, for the debt, and the preference shareholders. So this is the whole chapter I summarized. So let's move on to the next slide. We have seen that when appraising the investment project, a firm evaluate a project return using the company cost of capital, also known as the discount rate or cost of capital, to establish the present NPV. We need the cost of capital. Also, the another reason we need the cost of capital is of the because of the investment that we are doing, because we don't know after paying the cost of the capital, are we profitable or not. For this we have to do the npv calculation of a project. For this we need to calculate the npv calculation of a project to understand that whether the project is profitable or not after paying the cost of capital. So for this we have to calculate the cost of capital. This is one of the reasons that we need to calculate the cost of capital. Another reason is the that we have to pay the providers of finance, that we need to calculate how much is the our cost of capital that uh, we need to pay as a company to the providers. Okay, so for this calculation we have some format like 1 2 3, or sorry, I will start this from initially 0 1 2 3. Okay, here cash flow, discount factor, and present value. Okay, so for example I have invested £100. Okay, and we are expecting that this will give 10% return every year, which means the 10% income. Okay, so this discount factor is 1, but if the cost of capital is 10%, we are expecting cost of capital. Okay, so that is 0.1 divided by 1.1. We will calculate this. The discount factor, you can also get this from the table as well. Okay, 0.9090. Okay, 0. 0.9090. Likewise, you can calculate here as well. In the if we are divided by 1 here, then we have to do this twice, and we have to do this twice. Okay, so we have calculated this one. Then we calculate the present value by multiplying this one with this one, this one, this. Okay, this one, this. Multiply 100 multiplied by 1, 10 divided by 10 multiplied by 0.09. Okay, so likewise we will calculate here. So after calculating, this is the investment that we did in the business. So this is minus, and we have the this. So our NPV is negative, negative, negative something amount. So which means that this project is not worthwhile, because we are investing £100, but we are only getting 10, 10, 10, which is after the year 1, year 2, year 3. And in present terms, this is the value, this is the value, this is the value, this is the value. So this project is not worthwhile investing because the NPV is negative. But if the return is like 50 50 here, 50 40 hairs, and 70 hair, which means that the return that we are getting is higher than the 100. So this project is worthwhile putting the money, okay, after paying this initial amount. Okay, so for this calculation, we have whether the project is investment worthwhile or not. For this, we have to calculate the cost of capital, because cost of capital is very crucial in this calculation. If the cost of capital, this 10%, if this 10%, here is the 10%, but here if this is 15%, which means that this amount will be discounted by this cash flow will be discounted by higher discount rate. If this is discounted by higher discount rate, which means that this cash flow will decrease. So it is very crucial that we calculate this cost of capital in. So it's very important that we calculate this cost correctly. Okay, so the different types of cost of capital, different types of cost of capital. First one is the cost of equity, cost of debt, cost of reference share. Cost of equity can be represented by KE, cost of equity. Cost of debt can be represented by cost of debt. And cost of reference share can be represented by cost of reference share, KP. Okay, so for the calculation of cost of equity, we have to, if we pay the constant dividend, if we pay the dividend plus the growth rate, if we pay the dividend every year the same, if we pay the dividend plus with a growth rate. Okay, for this we have different calculations. And next is the CAPM that I will teach you at the end. Okay, in this, we have the redeemable, irredeemable, convertible, and bank loan that is not traded. And for all these, we have different calculations and we'll solve with you. Okay. And the cost of reference here is same as the redeemable. Is the same. Okay. Let's start this cost of cost of equity when we have the constant dividend. If you have the constant dividend, if you are paying the constant dividend to the equity holders, so we can calculate the cost, that is cost of equity, using the dividend divided by the P0. P0 means the share at price now at year 0. Okay, so constant dividend from year 1 to infinity, which means that dividend, if the dividend is 12, if the dividend is 12%, so we are paying the 12% from year 1 to infinity. We are paying 12% every year. Okay, the same dividend, and this is the dividend, and P0 means price, the share price at year 0, which means now. Okay, when we solve this, we will get the cost of equity. Next is the when we have the growth rate in the dividend. When we have the growth rate, that is dividend right now, that we have the dividend right now, plus the growth rate, that is 1 plus g in this here, which means I if we have the dividend for the right now plus the dividend plus the growth rate of one growth rate, which means that 1 year growth rate, which means that this 1 plus g is D1, which means dividend in year 1, dividend after 1 year. If D1 is the dividend at the beginning of the year, dividend is that is at right now. So when we convert, when we add the growth in this, we will get dividend at the end of the year, which is after 1 year. Okay, this is D1. Okay, so this is the growth rate. We have the constant growth rate in dividends expressed as, this is the growth rate, and this growth rate is constant. So for example, the dividend growth rate is 5%. So we have this dividend growth rate at 5% every year. Okay, and this is the share price now, share price at year 0, means the day we are calculating the cost of equity. Okay, so if we have the I mean the this growth rate different, it means the fluctuating growth rate, fluctuating growth rate calculation we don't have in the chapter in our ACCA FM. Okay, so we only have the growth that is constant growth rate. Okay, so next is the x dividend share price. So this share price must be x div. X div means after dividend, which means this price should not include the effect of dividend, because when the dividend is paid, so for example, if dividend is will be paid on this date. Okay, this date, this is timeline. If the dividend is paying on this date, so before this here, from here to here, this means this timeline is before the dividend is paid, and this timeline is after the dividend is paid. Okay, so when we have the before, which means the share price includes the dividend that we will pay. So because the in the stock market, price is based on the expectations and the reactions of the shareholders. So because the shareholders are expecting that the dividend will be paid in the future, so the share price will increase, and this share price increment will include the part of the dividend, which means the share price include the dividend as well. Okay, but after the dividend is paid, the share price will be off after excluding the dividend. Excluding the dividend, come means include, and x means exclude. Okay, so this share price must be after dividend, which means excluding dividend. If you are given the price that is inclusive of dividend, if you are giving the price that is inclusive of dividend, but we need the exclusive of dividend, exclusive, which means after the deduction of the dividend, we don't need share price that include the dividend. So we have to deduct the dividend from it. We have to deduct the dividend from it. Okay, calculate the ex dividend share price. So that's all. Let's move on to next. Okay, so let's calculate the cost of equity. The cost of equity. Okay, the required is the cost of equity. Right company has just paid a dividend of 60 cent and has a market value of $50, 5.50. Okay, the dividend growth rate is 8%. So this calculation includes the growth rate. This is the G, this is the market value, that is P0, and this is the dividend, that is D0. Okay, so let's do. So what is the formula for cost of equity for the with growth rate? The formula is cost of equity equal D0 1 plus G divided by P0 plus G. Okay, so how we calculate? Let's calculate D0. D0 is, this is cent. $1 equal 100 cent. Okay, $1 equal 100 cents. So how much is this? 0.60. 0.60. 1.1 plus 0.08. Okay, so P0 is 5.50 plus 0.08. So how much is the cost of equity? Cost of equity is cost of equity is 0.60 multiplied 1.08 all divide 5.5 plus 0.08 equal 9.78. 0.1978. Okay, you have to multiply it by 100 to convert it into percentage, 9.78%. So I can say that 9.78 is equal to 9.78 is equal to this. This is cost of equity. Okay. Okay, so next is the growth rate. How we calculate the growth rate? This growth rate is given here, but if it's not given, then we have to calculate by ourselves. Okay, so this is the formula based on historical analysis. So G equals dividend, current dividend divided by dividend n number of years ago, that is initial dividend, and you have to hide, this is parenthesis close, then the power 1 divide n, N is the number of years of dividend growth. This is the growth. How many years of dividend? How many years of growth in the dividend? Okay, how many years of growth in dividend? Minus 1, and D0 is current dividend. Okay, so we have to put this in formula and we will get the answer. Okay, so today is 1st January 20x7. Okay, PV company has just paid a dividend D0 cent. Okay, we have to convert it into dollar because this is given in dollar, that is current share price. So we have to convert it into dollar. 39.25 divide 100 equals 0.3925 cent. Okay, and this is x dividend, and previous dividends paid on 31st year as follows. So dividend that is this dividend is paid on 1st January, which means 31st December 20x6. This dividend is for 31st December 20x6. So I will write here the dividend of, it is given in cent. So okay, I will write it in cent, 39.25 cent. Okay, so we can use the formula or we can calculate it by using our normal average and divide it by 4. Okay, first I will use formula, then I will calculate by normally the growth rate and divide it by 4. Okay, so the G equal is current dividend. The current dividend is 0.3925 divided by dividend and number of years ago, that is initial dividend is 0.30 0.3000. Okay, this is dividend, and you have to close it 1 divide, and how many years of dividend? 1 2 3 4. How many years of compounding on the dividend? There is no growth here, the growth is 2.4 and then 5.4. so how many years of dividend growth? 1 2 3 4. Okay, so 4 minus 1. When you calculate this, you will get the answer. That is, let's do 0.3925 divide it 0.3000 all or 0.5 equal minus 1 equal, okay, you will get this answer 0.06 or 0.694. When you multiply it by 100, you will get 6.94, 6.94, or you can say that 6.95. Okay, 6.9. This is the correct answer. Okay, now you can calculate it by without using the formula, but it's a lengthy process. So you can like 32.4 minus 30, okay, 30 and then divide it by 30. So how much is this? How much is growth? This is 2.4 divided 3 multiplied 0.4 divided 3 multiplied. You don't need to divide it. You just multiply. You can multiply it later. 0.08. Okay. So how much growth here? 5.4 minus 32.4, right? 2.4 all 5.4 minus 4 all divided by 32. How much? 0.0925. So, okay, when you calculate all these 1, 2, 3, 4, when you calculate all these and you just add them and divide it by 4 number of years of compounding. When you divide it by 4, then whatever answer you get, then multiply it by 100, then you will get the same answer, that is 6.94%. The same answer you will get. Okay, but this is very lengthy, so it's uh, it's easy to use the formula in the exam. If you don't know the formula and not given in the exam, so you can calculate this by as well. Okay, so but try to use the formula because it's very easy to calculate. Next, let's move on the dividend growth rate. This dividend growth rate is using golden growth rate model. Okay, in this we calculate the growth rate using using when we have the, for example, we have the 100 and we made a profit of 10. Okay, when we made a profit of 10, out of which we distribute or we retain this amount. Okay, when we distribute, for example, if we distribute this, if you distribute to 8, so how much is the return here? 10%. How much is the return here? 10%. Okay, but we have distributed the 2 as dividend and we retained 8. So this retained, and what is the retained earning ratio? Retained earning ratio is 8 divided 10 or 80%. 80% retained. So this retained will become the capital part we put in the business. Then on this we will get the return 10%. So 10% of 108, 10% of 108 multiplied 10. Okay, so 8.64. Okay, so now, so this formula tells that if you retain the profit amount, then you will get a return on that as well. So for example, because you distributed the dividend 2 as a dividend, so if you retain that 2 as well in the business, so that means that your return will be on 110. So 110 is 11, so your return is now 11. So which means that if you retain higher amount in the business, your return will increase as well. So your growth rate in the profit depends on the how much you retain. So okay, so this is how we calculate the growth rate in the dividend. So by using this growth rate formula, the golden growth rate. So B is the retention rate, B is the retention, and B is the retention, R is the return on the equity. Okay, so 1 minus dividend payout, how much we paid as a dividend. So how much we paid as a dividend, then we will get how much we retained. Okay, so return on equity, you know that return on equity is after tax profit after tax or profit available for equity shareholders than book value. Okay, so this is the overall formula of the equity, but you can calculate the equity using this, the growth rate and without growth rate, using this growth rate model and without growth rate. Okay, if there is no growth rate, then this is not required. If the growth rate is given, then you have to calculate the using the growth rate. Okay, so let's calculate this question. What is the required cost of equity? Required cost of equity, RB is company J, X div, this is X dividend share price, this is the cum dividend share price fall, sorry, this is the cum dividend, and this is the X dividend, this is the cum dividend share price, and dividend payout ratio is 40%. Expected to return that funds will be reinvested at 30%. It means this is the retention ratio. The growth rate is BRE. B is the how much we retained out of this, how much we retained, dividend paid out 60, so 1 minus 0 0.60, 0 0.40 we retained, and what is the reinvestment rate, that is the what is the return that is generated on the reinvestment, that is 0 0.3. Okay, so what is the growth rate? The growth rate is 0.40 by 12. Growth rate is 12%. Okay, so we have to calculate the cost of equity. So cost of equity equal D0 1 plus G divide P0 plus G. Okay, so dividend, that is currently dividend, and for this dividend we have to take X div 1.25, 1 plus what is the growth rate, 0.12, and dividend that is paid, sorry, the price that is paid, price is okay. Okay, sorry. So how can we calculate? This is the share price, this is the share price. Okay, so we have to take the X dividend share price here, 1.25, Remember this, how we have to calculate the dividend at current. So dividend is not given. So if this is the without, this includes the dividend. Come dividend means this includes the dividend. X dividend means this price don't include the dividend. So 1.45 minus 1.25 equal 1.45 minus 1.25 equal, how much is the dividend? 0.2. 0.2 is the dividend. Okay, dividend d0. 0.2 is the dividend. So 0.2 multiplied 1.25. Well, multiplied 1.12 divide 1.25 equal 0.1792. So we have to multiply it by 100 to convert it into percentage. 17.92%. 17.92%. This is the correct answer. Okay. Let's move on to the next question. Next is the advantages of dividend valuation model and disadvantages of dividend valuation method. So advantages is that it is based on theoretical basis, because you know that it's very easy that you calculate all these numbers, but it is very easy to calculate. It is very easy to calculate. It means commonly used and relatively easy to understand. It's very understand. It is very easy to understand this dividend valuation model, because in dividend valuation model we put the formula and the numbers, and we can calculate the uh, cost of equity and dividend growth rate, and it is very logical and easily understandable that dividend growth, dividend that is paid right now divided by the price. So if the dividend in relation to the price, which means how much we are paying dividend in relation to the price, in relation to the price, so which is called the cost. So it is very understandable and easy as well, very logical. Okay, you know that it's based on theoretical basis. Why? Because the x dividend share price, x dividend share price means after dividend paid. So this is the price that is after the dividend is paid. We calculate it based on using the theoretical x right price. So this is not the actual price, it is theoretically the price, but it not represent the actual price. So which means that this dividend valuation model use the after dividend x dividend share price, which can be the theoretical x right price, which means that this this dividend valuation model is based on theoretical ideas, okay, not the practical actual price. Okay, so next is the using the objective comparison of different dividend paying companies. So if other company is paying dividend as well, which means mostly the companies pay dividend if they are have the shareholders. So if they are paying the dividend, so we can compare our price with our price to their cost of equity. Okay, because most of the companies use the dividend as a payment to the equity holders. Okay, next is the companies that pay consistent dividend, because the dividend, if the dividend is paid consistently, if the dividend is paid consistently, so you can calculate the dividend and the dividend using, you can calculate the cost of equity using that dividend. Okay, so which means that the this is the advantage. But if the company is not paying dividend, don't pay dividend, and if, because dividend is optional, so because dividend is optional, and if company don't pay the dividend regularly, so if in a year that don't pay the dividend, so it is hard to calculate the cost of equity, so dividend valuation make model fail there. Okay, so this is the disadvantage of this formula dividend valuation method. This is the disadvantage. The input data. Another disadvantage is that the input data used can be inaccurate. So if you put incorrect data, so the answer, the cost of equity will be incorrect as well. So like the market price that you take in the formula to calculate the cost of equity can be incorrect, because the market price fluctuate based on based on demand and supply, that is expectation of shareholder, expectation of shareholder expectation of shareholder expectation of shareholder of expectation of shareholder for the future of company. And you know that when the dividend is about to pay, when the dividend is about to pay, then the dividend and then the share price will increase, but after the dividend is paid, the share price will decrease. So it means that the price fluctuate based on the expectation mm, of the shareholders, so it may not be the correct data. Okay, so future dividend patterns assumptions. So in calculating the cost of equity, we assume that the dividend that we are paying, the rate that we are paying will be the same over the years. But in reality, shareholders may demand higher dividend, and this assumption will fail. So our cost of equity will be different as well. So our cost of equity may not be correct. Okay. Next is the growth in earnings is ignored, because growth in earning is ignored, because we take the dividend, then we take the price, but the earning growth we ignored, which is very essential for the calculation. Because if the we pay dividend out of the earnings, so it is essential that we consider the earning as well, calculate the cost of it. Okay, but it is not considered. Another assumption is that it is perfect market and may not hold true. Another, we assume that the share market is a perfect market, which means that it the share price increase or decrease based on based on expectations, and any expectation will be reflected in the share price, uh, will reflect the share price in real time. But this is not the case, because sometime that the sometime a bad news come in the market and the share price fluctuate after that bad news. But before this, it is not uh, not the not the it is not of not the actual price. So next is the less applicable for larger shareholders. It is not applicable for larger shareholders because it can influence the dividend. Because we assumed that the dividend payment will be same over the years, but larger shareholders can influence the dividend. Okay, so for them this dividend valuation model may not be accurate because they can influence the dividend. Okay, that we have to calculate the cost of debt KD. So debt can be irredeemable and redeemable. Okay, so here we are calculating the irredeemable debt, cost of debt. Okay, in this in this the irredeemable debt, the debt holders get interest plus repayment repayment of capital at the end. Okay, so let's calculate this cost of debt equal interest and the market value, that is the price that is prevailing in the stock market. Okay, and it can be the total here, the total interest and the market value, or total value of the debt. Okay, you can calculate it in total or in per debt. Okay, one quantity. So debt is the after tax interest. You know that interest is a and here we take this interest after tax interest. Okay, we take after tax interest. Okay, annual interest, that is dollar in year one. Okay, market value and the corporation tax rate. So let's calculate this. Lawson, cost of debt equal has 8%, loan note in issue that are trading at 82%, nominal value is 100. Generally the nominal value remain 100, like dollar 100, dollar pound 100. So we generally consider nominal value as 100 in ACCA questions. Okay, and tax is the 20%. So interest is 8%, 8% loan note, and trading at 82% of on their market value, which means the market value is is $82. Sorry, 82 is the market value. Okay, and interest is 108% is the interest, that is 8. Okay, 8 is the interest, market value is 82, and 1 minus tax rate 0.2 equals, you will get this answer. Okay, so it's very easy, but just you have to consider this interest after tax. Okay, okay, redeemable debt. So redeemable debt is when you get interest every year, plus at the end you will get capital repayment. Okay, that is called dividend redeemable debt, means the redemption of capital. Okay, And the assumption that is taken in this is that the market value of redeemable debt loan note is the market value of redeemable loan note is the sum of present value of interest and redemption payment. Okay, so the market value of this loan note debt is the sum of present is the sum of present value is the present value of interest and interest and repayment of capital, and we have to take this at present value and then add this. Okay, the total of both is the present value. So the next is the we will do example. So the required, what is the cost of that, that is KD. Now it is the 1st January 20x5. Wilco PLC has $100,000 5% 2008 redeemable loan note in issue. Interest is paid annually on 31st December. Okay. The X interest market value of a loan note on 31st January 20 on 1st January of loan note on 1st January 20x5 is $90, and the loan note are redeemable at premium. Premium means it is redeemable at 105, and nominal value is always 100 in our exam. Okay, so it is redeemed at premium, that is 105. Okay, so tax is 20% and the interest is 100 on the nominal value we take. This is 5 is the interest. Okay, so and the X interest market value X interest. So for this we have to calculate the IRR. Okay, for this we have to calculate the IRR. So IRR is the cost of debt in case of redeemable case of redeemable debt. In case of redeemable debt, cost of debt is equal to IRR. So why is the cost of debt in case of redeemable debt is the IRR? Okay, so let's calculate this. I will give you a very straight answer. Okay, that no one will tell you this, but I will suggest you, I will tell you that why cost of debt is the IRR in case of redeemable debt. Okay, let's first understand. For this we have to understand the NPV. Okay, so this is the cash flow, this is the discount factor, and then we calculate the present value. Okay, so like 0.90 something like this. Okay, and this is the NPV, net present value. Okay, so if this NPV is 0, which means that it is the IRR. IRR is where the NPV is 0, so which means that we are not making any profit. It means no profit, no loss. Okay, no profit, no loss. But if IRR is positive, which means profitable project. Okay, and negative means loss making project. Okay, so IRR is where NPV is 0. So So zero NPV means no profit, no loss. So but zero NPV does not mean that it is not covering its cost of sources of finance. So this is the sources of finance. We already know this. Initially we discussed this, that this discount factor is the cost of sources of finance. Okay, so this is the sources of finance. So if NPV is zero, if NPV is zero, which means that it is only covering, it is only covering, only cover cost of capital, only cover cost, but it is not making the profit, but it is only covering the cost. Okay, which means that it is only covering the cost. So which means that if it is covering the cost, if it is covering the cost, which means that if we are given this cash flow and this NPV and this discount factor and all of these, so can we calculate this? Can we year zero, year zero, year 0, 1, 2, 3, 4. Year 0 we will receive 90 from the debt holders, but after this year 1 we pay 4 as a as a as a interest, but it is after tax. Okay, so we will pay 444, and at the end we will pay 105. You know, this is the 5 premium plus the 4 is the interest, so we will pay this at the end. So how we calculate IRR? Just put this in the spreadsheet, IRR equal, and select all these, you will get the answer. Okay, so it's very easy. But if you want to go with the longer calculation, because sometimes you don't have the spreadsheet. Okay, so how do you calculate? You will calculate this by using the formula. That formula is given here. It's given here. This is the formula for IRR. Okay, so this is the formula you have to calculate, have to consider while calculating. Okay, so IRR equal lower rate. You have to take this one lower rate and one higher rate. If the is assumed, you have to assume this rate. So this discount factor we assume is if the discount factor rate is 7% and if the discount factor is 10%. So when we calculate this by using this discount rate, then you get this NPV, it is negative. So you have to consider the different rate. Okay, if it is negative, then you have to consider the different rate. Then one must be negative and one must be positive. Okay, you have to bear in mind that one discount factor must, one NPV must be negative and the another should be positive. Okay, if you if you still get the negative, then you have to this uh, change this discount factor so that you get positive NPV. Okay, then you have to put this at lower rate. What is the NPV? Sorry, what is the lower rate? Lower rate is the 7% plus, you have to NPV at lower rate minus 3.67, NPV at lower rate minus 3.67 minus 2.70. Okay, and you have to multiply it by 10 minus 9. Okay, multiplied it by 10. Sorry, 9. 9 minus 7. 9 minus 7. Okay, lower rate is 7. Then you have to calculate this and you will get the same answer. Okay, next is the convertible debt. Convertible debt is investors choose to convert between investor to choose between taking the redemption proceeds or converting. You can either redeem the shares, you can either redeem the debt or convert it into shares. You have the option. Okay, example, find the post tax cost of convertible debt to the company. Okay, if a company if a company has issued convertible loan notes that are due to be redeemed at 105 in 5% premium, 105 in 5 years, the coupon rate is 8% and the market value is 5. Alternatively, the investor can choose to convert each loan note into 20 shares in 5 years time. The company tax rate is 30%. The company shares are currently worth 4 and their value is expected to grow at rate of 7%. Company shares are currently worth at market value, that is 4. Okay, so now you have to compare the redemption value with the value of conversion option. Okay, so if you take the redemption value, that is convert it into cash, if you convert it into debt, or if you convert it into equity share. Okay, if you convert it into equity share, if you take the share, if you take the cash and you have the $100 loan note, then it is redeemed at premium, that is 5% above. Okay, so you will get $105. Okay, but if you convert it into shares, then you will get, for every 100 you will get 20 shares. Okay, so you will get 20 shares and each share is valued at 4. Each share is valued at $4, and this this price will grow at 7%. Okay, this price will grow at 7%, so it is 1.07 for the 5 years. Okay, so for the 5 years it will grow. Okay, so this will be the answer. So you will take highest because you have to increase. If you have the benefit in conversion, then you will convert it into shares instead of taking the cash. Okay, so you will go with the conversion. Okay, you will. So in ACCA optional questions, this is the only answer. You have to calculate some time that which one option should we choose, which one option the debt holder will go. Either he will take the cash or convert it into shares. So he has the benefit in convert it into shares. Okay, When he convert it into shares, then the redemption value that will be the this 112 the end of 5 years. Okay, so 85 is the 85 is the 85 is the market value he bought loan note, convertible loan note. 5 is the loan note, and he will get the 8% interest. This 8% must be after tax. Okay, the tax rate is 30%. Tax rate is 30%, that is here. So you have to take this here. 108% is 8, 1 minus 30%. So you will get 5.6 each year. Okay, 5.6 each year, and for the 5 years. Okay, 5.6 each year. Then you can calculate IRR. If you have the spreadsheet, then you just need to select this from here to here, and you will get the IRR percentage. Okay, you will get the same answer. And if you want to go with the long solution, then you can use the formula like this. Okay, and you will get the same answer. Next is the non-tradable debt. Non-tradable debt means it is not traded on stock market. Okay, so bank and other non-tradable fixed interest loan. Usually the bank loan is the non-tradable debt. Okay, so formula to calculate this is interest 1 minus t. It is after tax. Okay, so if the interest rate on a bank loan is 8% and 20% is the tax, then after tax it is the answer 0.8%. Okay, cost of preference here is this debt dividend divided by constant annual preference dividend divided by active market price or market value in present value terms. Okay, so this is the cost of preference here, KP. Let's do one example. Calculate the cost of reference share in one decimal place. Okay, the company has $100,000 reference share, 12% in issue. The nominal value the shares is $1. The market value is 1.25. So the dividend is dividend is 12, which means 1. The nominal value, dividend is paid on nominal value. Okay, and the price is 1.25. Okay, and that price is X dividend. That price must be X dividend. Because it is not said that it is cum dividend or X dividend, so it is assumed that it is X dividend. Okay, so now the answer is 9.6%. It's very simple. You just need to put the formula in it and put the numbers. Next is WACC, weighted average cost of capital. When we calculate the cost of capital of each, the cost of PT, cost of debt, cost of preference share, cost of bank loan, then what we do, we weighted average to use this into investment appraisal. Okay, this is the weighted average. WACC is the weighted average of all these costs. Okay, so overall, overall, how much required return company needs to generate. The company is financed by $10 million ordinary shares. Okay, so the required if tax rate is 20%, calculate WACC. Okay, so the company is financed by $10 million one ordinary shares and 8 million 8% redeemable loan note having the market value redeemable loan note, which means IRR. We need to calculate the IRR, market value, cum div and 90% ex div. Okay, the loan note are redeemable at par in 4 years time. This is another 1, 2, 3. Okay, and the dividend of 30% is about to be paid, and future dividend are expected to grow at this rate. Okay, so cost of equity is P1 plus G because growth rate is given and we have to take this P0 plus G. Okay, now the dividend is X dividend. The X dividend is 0.30 because it is in cent, so we have to write it by 0.30. 1 point, growth rate is 0.05. Okay, and the current share price is, this is the cum dividend, so we have to calculate it. We need X dividend, so we have to deduct the dividend. Plus G, the growth rate. Okay, how much is the cost of equity? Cost of equity is 30 multiplied 1.05 equal divide 1.60 plus 0.05 equal 0.2468, 24.68%. Okay, this is the same. And the cost of debt is that is redeemable, so we will get 8% interest. 8%, we have to calculate this IRR. So for this we will get the interest. It is issued at 90. It is issued at 90, so we have to take this at 90. Then we will get the interest is Interest is 8%. Interest is 8%. This one is the interest. Okay, 8% is the interest, and it must be after tax. So we have to calculate it after tax. So the interest rate after tax is this. Okay, 6.4, and the redemption that will be at redeemed, this 8% will be, loan note will be redeemed at par, which means 100. Okay, it is redeemed at 100. This is the interest. So 1, 2, 3, 100 plus 6.4. We have to put this IRR. You will get the answer 9.5. Okay. So this is the cost of debt. Is the cost of equity. This is the cost of equity. Okay. Cost of debt. So we need to calculate the value of equity. Now the value of equity is 10 million, 10 million, and 10 million. That will, the market value in current terms is the market value is this, but we have to deduct this interest. So the actual market value x div is 1.6. Okay, so we have to take this x div market value, x div market value for 10 million shares. So how much is the value of equity? 16 million. Okay, 16 million. And for the debt, it's 800. You will get the value at 90%, right? You will get the value at 90%. So it's the 90%. Okay. So the market value of the debt holders is $90. It is the $90. It is issued. Nominal value is 100 and market value is 90. So the market value is 90, which means it is 90%. So the 90% of this is 7,200,000. Okay, so this is 16 million. So now you have to calculate the WACC. So how you will calculate the WACC? Cost of equity and cost of debt. How much is the cost of equity? Cost, and we here put the weight, okay, the value. The cost of equity is 24.69. 24.69, and the cost of debt is 9.5. Okay, and for the VAT we will take this and this. For the VAT we will take this 16.0 and 7.2. Okay, we have to multiply it. Okay, need to multiply it this with this, and you will get 395.24, 68.4, 68.4 will get 463.4. Okay, and you add this one as well. So this is the weight. WACC equal 463.44 divided by 23 equal 19.7%. Okay, 19.97 or 20%. This is the same. CAPM. CAPM is the another method for calculating the cost of equity. So this is another method for calculating cost of equity. So in this method, we calculate it, okay, taking the risk-free return plus the this one, the relative level of systematic risk multiplied market risk premium for a specific investment. Okay, this is the beta and this is multiplied by the premium. Okay, so you don't need to worry about this right now. So let's understand this formula. This is the expected return, that is cost of equity. This is the risk-free return, that can be the government bond rate, because generally the government bond is the safe, and this is considered as risk-free return. Okay, so this is the risk-free return plus beta. Beta is the risk that a company pays than the age. Okay, so beta 1 equal to means equal to 1 means risk is equal to market risk. Okay, so risk of a company, so investing in a company is equally risky as investing in the market. Okay, so beta greater than 1 means it is more risky than the market. Okay, beta less than 1 means this is less risky than the market. Okay, so this is the beta, and for this beta we have the the risk premium. When we consider this, we will get the cost of equity. So risk premium is the market return that we are getting at the market return and the risk-free return. So above this is the premium that we need from the investment. Okay, so I will explain this by doing one question on this. Okay, so the risk for a shareholder faces a large part due to volatility of the company earning. Volatility occur because systematic risk and unsystematic risk. So this is the total risk is divided into systematic and unsystematic. So systematic risk is the economic risk and specific risk, company specific, and this is in general, everyone face. Okay, so if this is the everyone face means this cannot diversified cannot diversify if it is specific to the company, which means we can diversify by investing in another company. Okay, so if this company is risky company, then why we will invest in this company? Let's invest in another company that is not risky. Okay, so systematic risk is the all companies face in the same way, for example, but vary degree. For example, the recession affect all business, but some businesses are affected, like house builders. These are capital goods capital goods manufacturing companies, like house builders, tv fridge. These are the capital goods manufacturing businesses. But the bakers, that is the daily need, daily needs business, they will not be affected as much as the capital goods manufacturing, because daily need goods we need for the basic necessity, because bakers provide the bakery food items. So these are the basic necessities of human beings, so they are not affected even due to recession, because even people don't have the less income, they will spend on these. Okay, but they will defer the buying the house. Instead, they will live in the rented house, and they will not buy the TV. Instead, they will defer to buy the TV or fridge in the future. Okay, so this unsystematic risk is specific, do not affect everyone, and it is specific to individual companies. So some are losers. So, for example, if you have the wet summer, raincoat manufacturers will benefit, but sunglasses will suffer. Okay, so majority of businesses will not make any differences. Overall, stock market is unlikely to be affected by the weather. It is specific to companies, so this can be diversified by investing in different companies. Okay, so the next is the this explains why diversification works typically in a winner and loser regarding the particular risk. Beyond the impact cancellation, diversification can also eliminate unsystematic risk. Diversification eliminate unsystematic risk. Unsystematic risk means specific, that is company. So we will invest in different company affected by the same macroeconomics. Okay, the ability of investors to diversify away unsystematic risk by holding by holding portfolio consisting of number of different shares in cornerstone of portfolio theory. Okay, understanding the beta. I already told you that beta, if the beta is greater than 1, which means this is investment is riskier than average. Average means average return. Beta is the average return. RF here, RM is the average return. RM is the average return that stock market generate. This average return is, for example, if you have 50,000 pound, so here in India we have the Nifty NIF Nifty, and in which we have the 50 stocks. So each one you will invest 1111 and 50, and the return that this generate, so the return this generate, this is divided by 50. When this return is divided by 50, then the return is the RM. This is the average return that these 50 shares are providing after investing $50,000. This is the RM. And this RF is the risk-free return. Risk-free return. So how much is the risk premium that you need. The risk premium is this area. Okay, so if the beta is greater than, if the beta is greater than 1, which means if the risk of a business is 1, which means it is market return that is equal to, means here the beta is 1, which means Rm equal RF risk free. Okay, here, but here Rm will be greater. Okay, next we have the CAPM. CAPM is based on the number of assumptions that well diversified investors, which means the unsystematic risk is diversified. Unsystematic risk is diversified. We have the perfect capital market. The investors in the capital market have the perfect knowledge, and when they have the perfect knowledge of the market and everything, then the share price will include all expectations of future. Okay, which means this is perfect capital market. Unrestricted borrowing and lending at risk-free rate. So these are the assumptions that investors are well diversified, capital market is perfect, and borrowers can borrow any amount, any amount can be borrowed at risk-free return. Okay, all forecasts are made in the context of single period transactions. These are the some assumptions. Next is the advantage, works well in practice. So it is well understood that by calculating the beta, considering this from the market and risk free, then it is very practical, because we considering the risk of a company and the risk premium. So it is actually the practical, is after we are considering the all the stock market. Okay, we assumed unsystematic risk can be diversified, which means we are assuming unsystematic risk is 0. Okay, so we only considering the systematic risk. Unsystematic risk is specific risk. So specific risk can be diversified by investing in different companies, so it can be assumed here this is 0. So we can also write here that systematic risk, unsystematic risk assumed nil or 0. Okay, next we have the useful for operating specific projects. So we can use this cost of capital in the WACC formula, and we can use this as a that WACC in appraising the investment, or using the NPV calculation. Okay, in the NPV calculation. So the disadvantage is that it is less useful for investors who are undiversified. If, for example, investors are not diversified, here we assume that investors are diversified. So if the investors are not diversified, it is not useful. CAPM is not useful. Okay, his tax is not considered in this calculation, CAPM. Also, the actual data inputs are estimates. So like this the risk-free rate, the beta is also assumed that this company can be, the beta can be greater than 1 or less than 1. These are only the estimated calculations. So estimated calculations, but it cannot be the actual risk. So okay, so it is hard to obtain this risk free rate. Okay, so let's do this one question. Cost of equity, it's very simple, just need to put the numbers. This is the beta, this is the return, this is the RF. Okay. So we have this risk-free rate plus risk-free rate plus the beta, and we have the market return, that is 10, and we have the risk-free rate, that is 4. Okay, so we are calculating 9.4, but sometime now right now you are calculating this as 10 minus 4, 6, and this is the risk premium. So instead of calculating, sometime this is given in the question. If this is given, then you can directly use this in the formula. Okay, now this is the end of the chapter, I think. Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.